What if one single waterway, just 33 kilometers wide at its narrowest point, could shake the entire global economy? That's exactly what happened in early 2026. One strait, one conflict, and billions of dollars wiped from financial markets around the world. This is the story of the Hormuz crisis, and more importantly, what smart investors are doing right now. The Strait of Hormuz sits between the Persian Gulf and the Gulf of Oman. It's the only sea exit for countries like Saudi Arabia, the UAE, Kuwait, Qatar, and Iraq to export their oil and gas. On February 28, 2026, the United States and Israel launched military operations against Iran. Iran responded by effectively shutting down the strait. The result? Over 20 million barrels of oil per day, roughly 20% of all the world's seaborne oil supply, suddenly had nowhere to go. Companies like Saudi Aramco and ADNOC, two of the biggest oil producers on the planet, had to slow or even stop production because storage tanks were getting full with no way to ship. The impact was immediate. Oil prices, which started the year around $70 a barrel, shot past $110 in early April. At the worst point, Brent crude was touching $120. And when energy gets more expensive, everything gets more expensive. The countries hit hardest: China, Japan, India, and South Korea. All of them depend heavily on Gulf oil to run their factories and transportation. When your energy bill doubles, your economy slows down. Even Europe felt the pressure, not just on oil, but on liquefied natural gas. Countries like Qatar are major LNG exporters, and that gas heats European homes and powers European industry. The result? Inflation is rising again globally, and world economic growth is expected to slow in 2026 compared to last year. Now let's talk about the stock market, because not everyone lost the same way. The biggest losers? Airlines. Delta and American Airlines dropped over 15% in March alone. Why? Jet fuel is their biggest cost. When oil spikes, their margins collapse. Auto manufacturers, shipping companies, logistics giants like FedEx and UPS, all of them are watching their costs go up while demand starts to slow. Consumer goods and food companies are also under pressure. Everything that gets transported costs more. Everything that's made with energy costs more. That's a squeeze on profits. And some stock indices in Asia and Europe, they've taken real hits, especially in energy import-heavy economies. But here's the thing about markets. Every crisis creates two sides. The clear winners, Western oil producers. ExxonMobil and Chevron, for example, are sitting on oil fields far from the Gulf. When global prices spike, their profits explode. Both stocks hit multi-year highs during the crisis. Defense companies are another story. When a conflict escalates in one of the most strategic waterways in the world, governments start spending on missiles, naval defense systems, and military technology. Lockheed Martin and RTX Corporation have both seen strong gains. Even gold and other safe haven assets surged. Because when investors get scared, they want something stable. So what does this mean if you're thinking about your investments? Smart money right now is rotating out of fuel-sensitive sectors and into energy producers, defense, and hard assets. But here's the smarter move. Don't react emotionally. Crises like this always look catastrophic in the moment. Markets stabilize, prices adjust, new supply routes open. The real opportunity is understanding the structure, knowing which sectors benefit when oil spikes and which ones suffer. That knowledge doesn't expire when this crisis ends. One waterway, one conflict. A reminder that in investing, geography still matters. If you want more breakdowns like this, how geopolitics moves markets and what it means for your money, subscribe. New video every week.